Good evening, everyone. A warm welcome you to this webinar on benefit from Make in India through ETFs. We have with us today Mr. Siddharth Srivastava, Head ETF Products at Mirai Asset AMC. Warm welcome, Siddharth.
Thank you. Thank you so much, Hetty. Should I go ahead and talk about ETF as well as the NFO?
Yes, sure. So our audience is waiting to listen to this interesting topic we have created for them. Uh, and this new fund offering is also quite a emerging theme. And our investors would definitely like to listen to more about it. Please go ahead.
Sure. Thank you. Before I go ahead and talk about the product uh, and the fund, which basically both ETF as well as fund of fund, which we are coming out with, let me first talk about what is passive investment and then what is ETF and quickly why we are coming out with a fund of fund also. The concept of passive is really simple. Basically, your active fund managers, the people who manage, let's say, a large cap fund or a flexi cap fund or a multi cap fund, typically seeks to outperform the market, seeks to outperform the benchmark. The idea of an active fund is basically to generate excess return. If you're talking about large cap fund, then excess return over Nifty 100 or BSC 100. Now, in trying to achieve that, they can underperform the market also, right? Like we are seeing with a lot of large cap funds in India right now that they are not able to generate excess return over the benchmark like Nifty 50 or Nifty 100. So hence comes the idea of passive. What passive fund like ETF or index funds does is that instead of trying to outperform the benchmark and uh, in that process maybe end up uh, underperforming it, the idea of passive fund is to simply replicate the benchmark by investing in all the stocks which are forming part of the benchmark. And this I'm talking about equity uh, investment point of view. So for example, within large cap category, a Nifty 50 ETF will invest in all the 50 stocks which are forming part of Nifty 50 index in the exact same weightages. A Nifty 100 ETF will try to give you the performance of Nifty 100 index by investing in all 100 stocks in exact same weightages. So your risk of underperformance is completely or majorly gone, right? Because the only objective is to simply mirror the underlying index. So your fund manager risk of underperformance is taken away. And typically, because you don't need an investment team or a fund manager to manage the portfolio because you're simply replicating the benchmark, typically your ETFs and index fund come at a very low cost, and that also becomes very important, especially when you are talking about TER differential of let's say 1.5% uh, between active funds and the passive funds. Now, passive funds are of two type. Quickly, one is in ETF, which which not only replicates the benchmark, but it also trades on exchange. And as in let's say one unit, so you can buy or sell ETFs on the exchange in one or multiple of one unit. Now, the advantage which ETF bring is that typically whenever you're buying a mutual fund, you only get to buy it at the day close now, right? That is your purchase price or the redemption price. But in case of ETF, since it is buying and selling on the exchange, you can buy it at intraday net asset value. So for example, if let's say Nifty 50 opens and by 12 o'clock it is down by 2%, you will be able to buy the Nifty 50 ETF at a NAV which is 2% lower than the NAV of the concerned Nifty 50 ETF at yesterday's day close. Whereas in case of mutual fund, you'll be only able to buy based on the day close NAV, which let's say Nifty 50 was down by 2%, but it ends up by 1%. Your purchase price will be up by 1% because the mutual fund transaction happens at day close NAV. So this is one very big advantage that people are able to take advantage of intraday movement also, buy and sell based on intraday prices, and that is why ETF can be used for short term uh, tactical allocation or taking benefit of market movements also, or it can be used as a simple fund where you invest and for a let's say a longer horizon of 5, 7, 10 years. Now, index fund also does the same thing like passive fund, but it is not listed on exchange. It works like a normal mutual fund. Your transactions are only at day close NAV. The only difference between an active mutual fund and index fund is that index fund replicates the underlying uh, benchmark. Now, the reason why we are also coming out with fund of fund along with the ETF, so this ETF which we are coming out with will track the Nifty India Manufacturing Index by, as I mentioned earlier, by investing in all these stocks which are part of Nifty India Manufacturing Index. And this ETF will be listed on exchange also. You can buy it at or sell it at intraday pricing also. And we, Mirai Asset, we ensure that enough liquidity is present on the exchange to ensure that your buy or sell transactions are taken. Now, the reason why we are coming out with a fund of fund is that a lot of people do not have a demat account, they do not have a broking account, or they do not prefer to buy and sell uh, uh, units on the exchange, and they prefer a normal mutual fund route only. They prefer to do SIPs, STPs, etc. And for those people who do not have a demat account or who do not want to go into broking account and buy and sell units on the exchange, want to avail SIPs and STPs, etc. For them, fund of fund option is there. So what fund of fund does, it invests in the ETF only. So ETFs are investing in all these stocks forming part of the index, whereas the fund of fund buys the ETF units. Ultimately, more or less, fund of fund also tracks the performance of the index because it is investing almost 99% plus in the ETFs, and the ETF movement is corresponding to the index movement, and that is how your fund of fund movement is also corresponding to the index movement. So we are coming out with both ETF as well as the fund of fund. So that was the basic of ETF and index funds and why fund of fund, etc. One major difference is also, just for the sake of clarification, is that ETF has a TER which will be typically lower than the TER of the fund of fund, because fund of fund has a two-layer of cost. So if, let's say in this example, the ETF will have a cost of, let's say, around 42 basis point, 42, 43 basis point, including the GST. The fund of fund direct plan will have an additional, let's say, 18 to 20 basis point of cost, because it's a, so ultimately you are talking about a fund ETF which is around 42, 43 basis point versus a fund of fund which is around, let's say, 60, 62 basis point for the direct plan. Now the NFO is already open. It opened for both ETF as well as the fund of fund on 10th of Jan. The NFO closes on 20th of Jan for the ETF and on 24th of Jan for the fund of fund. Now this is very interesting product we are coming out with, right? Whenever we talk about Indian equity space, we typically talk about banking and financial services stocks. We talk about IT consultancies. We talk about consumption sector plus Reliance. So typically, if you open any large cap, flexi cap funds, you'll find these sectoral allocations towards BFSI, IT, consumption, uh, plus Reliance, and few other here and there. Whereas typically manufacturing segment, which is one of the most one of the important segments Indian economy gets left out, and it's a huge segment, right? You are talking about autos and pharmas, capital goods, metals, petrochemicals, consumer durables, chemicals, etc. So many things get manufactured. There are a lot of companies and a lot of segments which are uh, involved in manufacturing ecosystem of India. But then question is, why now? Why should we focus on this theme now? So the points are two. One is that recently uh, government has also started giving a lot of focus on manufacturing segment through schemes like Atmanirbhar Bharat, through production linked incentive scheme, and also secondly, this is one segment which, if you look at underlying fundamentals right now, has potential to give good returns from next 5 to 7 year point of view. And also truly, this fund will result in diversification in a true sense, because because the sectoral exposure which this fund has is not there typically in other schemes. Now to start, now manufacturing, India three has a GDP of around $3 trillion, right? It is one of the world largest economy, but manufacturing segment till now only has it was around 12%. We have managed to increase it to 17%, but that is still very low. We only contribute to around 2% of world's manufacturing output, which is tenth of what our neighboring country China does. And manufacturing segment is very important, right? If we have to integrate India in global value chain, and if we have to nurture the tech segment, especially on the hardware tech side, we have to do much more on the manufacturing aspect. And that is why, through various schemes like PLI, government intention is to propel this space and increase the contribution of manufacturing segment in GDP to around 20% in coming decade. And that is one reason, right? Apart from the fundamentals of these companies, there is a significant push which can grow this segment as a whole. And that is why probably this fund right now makes more sense. And this is not something which is happening right now. Even if we look at the pandemic, and we know that government has been trying to focus on manufacturing segment for a while now. But before pandemic also, Indian manufacturing space was doing well. In fact, the India's manufacturing GVA, which is gross value added, grew faster than China in 5 year preceding the pandemic, especially in segments like machinery, steel, chemical, excluding pharma. To an extent that India's GVA was up by 7.1% in those 5 years compared to 5.9% uh, of China. So basically, the indications or roots were already set in terms of manufacturing segment to do well, but it in a way got temporarily halted during the uh, lockdown. But in 2021, India's manufactured goods export grew by almost 42%, manufactured goods to global growth of 27%. So almost a 14% higher growth in the manufactured goods export. But still, after all this, as I mentioned earlier, our manufacturing segment contributes 2% of global manufacturing GVA compared to 12% for agriculture and almost 2.7% for services. So there's a lot of potential which is there in this segment, and in this presentation we will be talking about what are the various levers uh, because of which manufacturing segment can grow. So first, let's talk about the government initiative, right? Because because that is something which will play a very important role on how this sector does. So government has been trying to do a lot in this space. As I mentioned, Make in India was one initiative. Then it came with a very innovative scheme, which is production linked incentive scheme, where what government is now trying to do is trying to have a more focused approach. So the idea is that that the government will focus on 13 sectors over next 5 years. The incentives will be in tune of 2 trillion rupees on an aggregate basis. Rather than spreading this incentives thinly across multiple players, what government will do is that they will identify 5 to 10 champions in each sector and try to incentivize to the tune of almost 5 to 10% of revenues if the output targets are met. So government is trying to increase the production output in 13 sectors through 5 to 10 companies which they will shortlist. And this 5 to 10% of incentives uh, is a very significant incentive for companies to invest and produce more PLI schemes. So we are essentially talking about PLI alone driving the production up by almost rupees 30 trillion, because then only at a 5 to 10% incentive you are able to pay out almost 2 trillion rupees of incentive. So this output is going to significantly drive up the manufacturing segment, and not only the companies which are directly incentivized, because these companies are not working alone. The entire value chain, entire supply chain of the concerned companies will be in a way incentivized to produce more. Couple of things which government is focusing on, especially is to increase the value addition. Let's say one focus in, especially in mobile segment, is to increase the value addition from in a way government is, let's say, to 30%, focus on sectors like autos, like electronics, mobiles, ACs, where India has some sort of competency, already has some export market, and let's focus on these market and try to make them more competitive compared to other countries, and try to increase their export contribution. Also, one very straightforward target has been the import substitution, that the things which we are importing, which and that is how increase the manufacturing output within the country. And this policy has already getting implemented, right? And from a impact point of view, it can, if implemented correctly, it can help GDP grow incrementally by around 75 basis point to 100 basis point, which is 0.75% to 1%. In terms of incentives, it is very well spread out, right? Almost 52,000 crores in mobile and other electronics, almost 25,000 crores in automobiles. Significant amount goes into advanced chemical cells in pharmaceuticals and textile products. And then also there is a significant outlay in white goods, specialty steel, even in solar power and other segments. So, so the focus has shifted. If we look at MEIS, which is Merchandise Exports India scheme, where see on the left hand side, the focus was on increasing exports through jewelries, chemical, agriculture, etc. The focus has shifted towards heavy industrials. In terms of proportion, the highest incentive goes comes automobile, pharma, battery, telecom, etc. So the government focus has shifted in increasing the growth and the prospect of these industries, unlike ever before. And this, as I mentioned earlier, that since the entire scheme is linked to increase in production, it will also result in increase in capital expenditure by several companies, and we expect that PLI alone will cause companies to invest more than $21 billion in capex. And also, as I mentioned earlier, there is going to be a significant impact of on GDP uh, due to PLI scheme. We expect India to grow incrementally more by almost 0.75% successfully implemented and ultimately achieve the goal of at least 20% contribution of manufacturing segment in in the India's GDP. Now that was more so about the push from the government, because as I mentioned earlier, there are two things which are working in favor of this sector if we are looking for investment opportunities for next 5 to 7 years. One is that fundamentals of companies, of a lot of segments have improved, goods, etc. And then there's a possible demand recovery in segments like auto, and then there's an opportunity of new technology and again auto through EV and battery tech. So we are talking about not only demand revival, better balance sheet due to better deleveraged balance sheets, better capex plans, and obviously demand recovery in several segments, aided by the government push through schemes like PLI and Atmanirbhar Bharat, which we see working for this space in coming future. In case of, so what I'll do is in next 5 6 slides I'll quickly run through the sectoral view, and if you want to go into more details, read it in a more thorough basis, then you can go to Mirror Asset website, and you can find this presentation on the website itself. Now in the auto segment, the recovery was seen in last 12 months, especially which was driven by the number of first time buyers. We expect just now the replaced demand has remained subdued, but we expect that to improve going forward. And also there is a buoyancy in rural economy and sequential improvement in financing. So with increasing per capita income, we expect more penetration of auto. Recovery in economic activities will drive higher freight demand, and obviously we expect improvement in supply chain, resulting in higher production in PVs and CV segment. Also, one very interesting thing which is happening in auto is the emergence of electric vehicles. We have already seen decent amount of companies which are moving towards EV. We expect by 2026 a percentage of EVs share in total two-wheeler sales to rise up to 17%, and in four-wheeler sales to rise to almost 12%. So this will also help in the overall growth of the auto segment. And also on the ancillary side, where we see a PLI push also for companies which are involved in battery technologies. Industries from a PLI point of view, the focus is more so on ACs and LED. The forecast is that industry, which was around $11 billion, will grow up to $21 billion by 2025. Again, one of the major focus of the government is large scale electronic manufacturing, which has an outlay of almost 41,000 crores over next 5 year. And apart from the increased production, uh, which is one of the focus areas of PLI, we also expect the value addition to grow from 15% to 30% in this space. Now, pharma is already in terms of generics. We have seen good amount of market share. For example, in US generics, our market share is around 46% right now compared to 9% in 2006. And we also expect under PLI, the pharma industry to get an incentive of almost rupees 219 billion, of almost 40 billion over next 5 years. This also adding to the fact that we expect this industry to grow by almost 12% this decade from the current size of almost 42 billion. On the chemical side, a couple of things which are playing well is that globally, a lot of MNCs are looking for uh, space outside China, and here India can very well become the China plus one player. As I mentioned earlier, import especially to the tune of 11 billion in this space, and the capex plan of the chemical companies just highlights to the fact that there is a significant robust underlying demand for this sector. Now, I'll cover metals and capital goods in just in very briefly, saying that during the time of pandemic, these companies have been able their balance sheet. The balance sheet have become more robust. There is a capex plan, significant capex plan from this segment also, which just highlights the demand expectations which the companies in these segments have. Also, for the capital works is the government push and government focus on Atmanirbhar Bharat, which is especially on the defense side is going to create more demand and orders for these companies, resulting in the top line and the bottom line growth. So just to summarize, the manufacturing space fast have been able to delever their balance sheet is looking stronger. Uh, we see that a lot of companies are having strong capex plan under, let's say, better which are there are chemicals recovery to happen in segments like due to the push by the government, especially through these schemes like PLI. We expect the entire segment to hopefully do well from next 5 to 7 year point of view. So that was a very brief outlook on the manufacturing segment. Now let's talk about the index per se, right? Because as I mentioned earlier, the role of the ETF look per se, right? Index by investing in that was now let's all the companies which are forming part of the index. So is NSE. The initial universe is top 300 stocks, which are basically all large cap stocks, all mid cap stocks forming part of Nifty Mid Cap 50 index, and top 50 small cap stocks, which forms part of Nifty Small Cap 50 index. So the initial universe is 300 stocks. Then NSE has identified basic industries which form part of the manufacturing space. So they have gone to the most identified these segments which represents the manufacturing segment. So from all these industries, top 75% of stocks in terms of market cap are chosen. So each industry will have 75% representation. from the top segment, from now space, from commercial petrochemicals, etc. The idea is to create a portfolio which captures the entire manufacturing ecosystem. Representative of the manufacturing segment, the automobile and weight each. So automobile will have at least 20% weight and industrial manufacturing will have at least 20% weight at the time of rebalancing. And no stock will have more than 5% weight in the index. Now this is look like different it is from the other products. And that is why I was saying that it will based on the performance, diversification again concentrated on PF. India get plus from auto and industrial manufacturing, around 18% industrial manufacturing, around 18%, oil and gas at 9.3%, consumer 7%, chemicals around 6.4%, fertilizers and pesticide around 3.6%, and just 14%. Look how contrasting it is from Nifty. White goods are 500 Nifty 50 space, which is fact because it will give you around, in true sense, you are investing not which is so different from what is typically available in large flexi cap space and on in Nifty 50 50s or large cap based index funds and ETFs. From a representation point of view, portfolio 32 space and 4 from small cap, 63% representation in the portfolio. Now let's look at return because that is perhaps are from large cap space and 43 are from one of the more important things which people look at. But one very has around 36 return because that is perhaps but one very is that manufacturing in India, which you believe will do well from a next 5 to 7 year point, and to board the train before the upswing starts. So if you are bullish on manufacturing, come when this segment for it to grow too. In last 15 years, it has given 11.7% return compared to 11.6 of Nifty 50. In last 10 years, it has given 14.2% return. If you look at 11.7% compared to 14.8% of Nifty 50. So it has given reasonably vision. So from a longer point of view, actually is not true turn point of view if you're looking at 10, 15-year data or since inception data since 2005. I think more eye-opener is when we look at calendar to upwards. So manufacturing index has outperformed Nifty 50 in last six upwards Nifty 50 in the years. So formed Nifty 50 by almost 9%. In 2020, it has outperformed. In 2017, it has outperformed. Same in 16, 15, and 2014. So it has outperformed In 2017, it has outperformed. Same in 16, 15. It has underperformed is that markets were polarized, which because of which only few segments of the market were performing. Even Nifty 50, there were only top 10 to 12 stocks. Clear point of view, it has done well in 6 out of last 8 calendar years. And also one thing which we should remember is that typically manufacturing segment is associated with cyclicality, and it is the growth of the country, and the country good numbers from a growth point of view, or the market is recovering. For example, return compared to 77% by Nifty 50 in 2014, when there was an optimism. Also, it gave 47% return compared to 33% characteristics also, but even in 6 calendar years. Now, in terms of constituents, like I have said earlier, it consists of companies across the domains forming part of manufacturing segments, manufacturing to metals, petrochemicals, chemical, and that is why you can see a list of companies across the segments, with a top company having a weight of less than 5%, which is Reliance Industries at 4.9%. So in between rebalancing, it can go above 5% also, depending on the relative price movement of the stocks. So I've just got the message to switch off my video because I think my voice is lagging. So I'll switch off my video. Yeah. So I hope my voice is better now. Now, as I mentioned, that this, in terms of valuation, also, if we look at manufacturing index is trading at 21.6 p compared to the 15 years average of 21.4. So just above the average. So it is probably not about the average based on 12-month trailing PE. And based on price, 15-year historical average of 3.18. Presentation, basically, we believe that manufacturing segment of Indian economy will do well from next 5 to 7 year point of view, especially assisted by various initiatives like production linked schemes, which has to almost 0.75 to 1% to the GDP, move the contribution 30% and incrementally increase the production of manufactured goods and increase the capital expenditure. We are also bullish on pandemic. They have been able to delever their balance sheet and are having good capex plan because of the underlying demand in spaces like auto. We see demand recovery happening, and also are keen on the developments which is cycles. Apart from this, the low funds will help you truly diversify your portfolio, and maybe a bit more cyclical, but it has outperformed Nifty 50 index in last 6 out of 8 calendar years. 8 calendar years. And because this is an ETF and a passive investment vehicle, both ETF as well as fund of fund. Now, I've already mentioned the start that NFO is already open. It will continue till 20th Jan for ETF until 24th of Jan for the fund of fund. So investors who have demat account who are comfortable on buying and selling, which will have an expense ratio of around 40 to 43 to, let's say, use a normal mutual fund route, do SIPs, STPs, etc., can opt for the fund of fund point, including the cost of underlying scheme basis point, which includes the cost of. That's it from me. Back to you, Headley, and NF in front of the audience.
Thanks, Siddharth. Uh, Thank you for that very detailed understanding about the manufacturing sector. Uh, we will try to uh, highlight the points in our follow-up mailers to our participants. Uh, there were some internet issues, hence Siddharth's voice was lagging. But we'll provide you a detailed presentation on the manufacturing sector for you all to go through. We'll move to the second half of the session where I will take you all through IIFL's ETFy platform, following which we will take up the question and answers from our participants. Uh, I'll just share my screen in order to showcase the IIFL's ETFy platform. This is IIFL's ETFy platform, which we have created dedicated theme-based baskets in order for our customers to take access and make ETFs a major part of their portfolios. Before we get into what the themed based baskets, I will just take you all through why ETFs. Firstly, ETFs are far more cheaper compared to actively managed mutual funds. So if you talk about large cap ETF, the expense ratio is barely 7 to 8 basis points. Whereas if you look at an actively managed mutual fund, the expense ratio would be anywhere between 1.5 to 2%. These ETFs are tax efficient. All that you have to do is hold on to the ETFs. The underlying ETF, uh, the stocks in the portfolio keeps on rebalancing in line with the index. Uh, if you do that on an individual basis, there will be higher tax impact. But on purchasing an ETF, you do not. You have a much lower tax impact on account of rebalancing. Only when you sell an ETF, the long-term capital gain or a short-term capital gain would be applicable to you. The theme-based baskets which we have created for you, they start as low as 500 rupees. So hence you can experience ETFs by investing a small amount and see how it fares in your portfolio. ETFs, like Siddharth mentioned, you can purchase ETFs during the day and take benefit of intraday volatility. There is no lock-in for ETFs, so you can buy an ETF and sell it anytime, and you get diversified asset allocation. So there are different types of ETFs. You have debt ETFs, equity ETFs, gold, and now even silver ETFs are available. So you get a lot of diversity. You can diversify your portfolio by investing in ETFs. If you go click over here, you can see the portfolios, um, the baskets which we have created for you. So we have created 7 types of baskets addressing various themes. For conservative investors who are looking to beat inflation, get slightly higher returns than your FDs, and are willing to take a little bit of risk, Access Hybrid Wealth and Answer is a basket which we have created for you. It has around 80% debt, 20% equity. Uh, you can go ahead and buy this basket for by investing barely 953 rupees. It's a recently launched basket, so have a look at it. The Nippon India transformation, this basket caters to the capex theme. Uh, Significant amount of capital expenditure is likely to be incurred in India, and by investing in this basket, you can capture the entire theme of capex. India consumer, this basket gives you access to the best consumer focused companies, not only in India, but also globally. So you get, by investing in this basket, you get access to companies like Netflix, Amazon, Google. Uh, just a minimum investment of 430 rupees is all that you require to participate in this basket. Sustainable India, this theme, this basket caters to the ESG theme. Um, it's a very prominent theme and a developing theme, and it should do well over the next decade or so. Smart portfolio. This basket we have created, keeping in mind those investors who want low volatility, would like a diversified portfolio, as well as are value conscious in terms of valuations. So we have made a mix of both. So an equity come gold kind of a basket, and uh, the ETFs in it cater to this kind of theme. Emerging opportunity. This is for the aggressive investor. It's a mid cap focused basket. You get access to largely to the mid cap sector by investing into this basket. And India's top 250. This basket gives you access to the top 250 companies in India, a predominantly large cap basket. If you Once you click on each of the basket, you can run through the entire details of what is the theme. All details are given here, the minimum investment. You can also see how these baskets have outperformed over periods of time. You can start an SIP as well as a lump sum investment. So you can do both. It is just like how you do it for mutual funds. You can start a SIP as well in these baskets. All you need to have is a demat account. This is open only to IIFL customers, and hence, if you do not have an account with IIFL, please open one. With that, we will move into the question and answer section. Are you there? Siddharth? Yeah. Can Siddharth hear us?
Not sure. I guess there are some network issues.
Okay. Okay. So I'll just go through with the questions. We'll try and answer as many as possible. The first question is, should I select sectoral ETFs or sector mutual funds? Uh, so basically, uh, when investing in an ETF, it's a passive way of investing. Sectoral mutual funds, when you talk about them, you're talking about active way of managing money. You could do a mix of both. You could accordingly, have a 60-40 kind of an allocation into passive and active, and you can get the benefit of both passive management as well as active management. Next question, in terms of, can SIPs be done in ETFs? Yes, just like the way you do an SIP in stocks, you can use the same options and do an SIP in ETFs as well. Can I use ETFs to achieve financial goals? So basically, ETF is an instrument just like a mutual fund. If you continue to invest in an ETF, you will receive market returns, and these market returns are more than sufficient in order to achieve your financial goals. You have to understand the amount of investment required in order to achieve your financial goal. If you invest as per that, you will receive market-based returns when you invest in an ETF. And ideally, you should be quite comfortable in terms of achieving your financial goals. Can you touch upon the liquidity aspect of ETF? So most AMCs have appointed market makers in order to take care of liquidity requirements. For retail investors, most of the ETFs are highly liquid. The AMCs market makers do provide sufficient liquidity in order to cater to retail demand. What percentage of portfolio should I allocate to ETFs? That entirely depends upon the return expectation which you have, and it will depend on case-to-case basis. So if you're looking at significantly higher returns than compared to the benchmark or the market, you would have to allocate and take higher risk in the form of actively managed mutual fund. If you are comfortable with market-based returns, uh, like low expense ratios, go in for make ETFs your core portfolio, and you can always have some minor portion of your funds allocated to actively managed mutual funds. So with that, we'll come to a close on this webinar. I would like to thank our participants for attending this session, and there was a lot of requirement in terms of having a session in Hindi. We will definitely take care, and we have taken down the consideration. So our next webinar, we will try to have it in Hindi for our audience. With that, we'll come to a close. Thank you so much for participating, and thanks Siddharth and thanks Karthik for helping us coordinate the session. Thank you so much. I'm going to disconnect your lines now.
Most welcome, Thanks again.